SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner of Search Fund Ventures, co-founder of SMB Investor Network, and today I'm joined by Ian Reynolds, managing partner of Thesis Capital. Ian's got a great background and a strong track record as an independent sponsor and self-funded searcher earlier in his career. He's going to share with us some insights and tips for folks that are interested in investing in independent sponsors. So Ian, I'll let you introduce yourself.
Thanks, Sean. Thanks for having me on. I haven't done one of these in a long time, so it's going to be a renewed experience for me. So thank you very much.
That's great. Well, why don't we kick it off by giving a background on yourself and Thesis Capital, and we can talk, about some of the deals you've done and exited and all that good stuff.
You bet. So where to start? I always like to start sort of right out of school. I think that's helpful context. How do you get into this sort of thing? And in my case is somewhat by accident. I discovered an interest and passion for business later in my academic portion of my career. So I worked in startups for a number of years and helped launch a bunch of random things to market. Thankfully, these were not my startups. Then went into consulting and did a lot of transactional finance work. Had the opportunity to do something like $10 billion in transactional finance. So restructuring, M&A, you sort of name it, parts of the world that I want to go back to, sort of thing, worked till 2 a.m. Type thing. And I learned about investing through that experience. I was looking at those businesses really through the lens of an advisor and helping to facilitate transactions. And I was like, man, these things make no money. Like these are crazy deals. Like who would do this, right? You're talking about very large flows of capital for these large deals. So I started looking. I was like, well, what is an entry vector for someone like myself to do this? And learned about search funds from someone who was a couple years ahead of me at school. And they said, oh, I'm going to go do this, and this, and I'm going to be the CEO of a company. And I thought to myself, well, how are you going to do that? You're just a couple years older than me. That doesn't make any sense. So tell me more. And they did, and I was hooked. I mean, it just read everything. Within a period of 5 or 6 months, this was around 2017, I had run around and raised half of my units. You typically raise anywhere from 15 or so units. I'd raised, I think, 7 of the units. I hadn't called the capital yet, but at the same time, I found a deal, and because I had gotten the advice to look for the business, right away, right? And so I had already started doing that. So I started like shopping the deal to the other investors I was trying to bring in on the last set of units, and no one liked it. So that kind of turned me off to the traditional approach. So I pivoted. I just said, hey guys, like I'm gonna go buy this thing. I'll do it myself. Everybody was fine with like exception of like one guy. One guy who just like lit into me. He was like, how could you do this? Da, 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 da. Anyway, I've sent him deals later and we're okay. It was pretty fun experience. So that was the first transaction. So I ran that business for 4 years, almost 4.5 years. And then I had a recapitalization / exit in 22. So September of 17 to 20, kind of running that platform and really kind of cut my teeth, if you will, doing that, getting my hands dirty. But thereafter really pivoted to this current model where we partner with exceptional talent, exceptional management teams, and do things that we deeply understand. And I can go into that in a little bit more detail to acquire businesses that are really ready for that generational change. And I can talk about our investment philosophy and criteria and these sort of things.
That's great. And I think, when we first spoke, it sounded like the outcome generally of your kind of first almost hybrid traditional turned self-funded search deal was pretty strong. Since then, you've had a couple more
That's right.
outcomes.
Yeah, so we've acquired, let's call it 6 businesses, but of the companies that we have exited, we've exited three of those assets, including that first transaction that I told you about. And all of the outcomes have been positive. And we for some assets they're newer. I don't know, as we've shifted the model, that those are assets we would necessarily exit, but we certainly would recapitalize, create opportunities for liquidity for investors that are comparable to an exit type things. But so far so good. So let's call, of the 6 that we've done, three have exited, and we've been very, very pleased with the results. And I think that comes from being very disciplined about, like, we try to only do things that we really, really understand. So
that's great. Yeah, I think, for a lot of folks in the space, because there's been so much more recent interest, especially investors that are newer to the space, it's hard for them to find great operators and great sponsors with a track record, right? So that's puts you in a unique
Yeah.
position on that front and gives you a great position to talk about things like how your investment thesis has developed and where it started, where it is today. So maybe we go a little bit into that, right? You've got somewhere you started with your self-funded search deal. You found something you were excited about, and you had built a thesis around that. But how has that thesis grown into this more operator-led model where you're building a portfolio rather than searching for one business? What's
Yeah.
changed, I guess?
Yeah, great question. And it's something we're constantly talking about, right? So we're always trying to refine that. So I can talk about where it is today. It really started from me doing something that I deeply understood, right? I saw an opportunity. Certain investors didn't see it clearly. They didn't want to participate. So that concept has stuck with me, right? Same is true with the business, right? You carry things to a point where you're like, yes, I'm certain I understand this. And that conviction is backed by experience. Of course, trying to be look for all of the sets of examples that would cause you to shoot down a deal. In fact, I'd say inside of the firm, I'm the devil's advocate of like, why should we not do this thing? Tell me why. Tell me why. Tell me why we should do that. And you want to ask yourself that set of questions all the way through. But I'd say what we've evolved to from that early set of criteria of, hey, I just deeply understand this set of problems includes the following. It's not limited to this, but we want management teams and management continuity that's going to continue with that opportunity. These small businesses in particular, sometimes they have a sort of an Uber manager risk where you have a one manager or the owner that is a one man band. They have expertise in marketing. They have a visceral sense of what sales is going to do without really even kind of managing a pipeline. They're developed an intuitive sense about accounting sort of processes, et cetera. I mean, they know proverbially where all the bodies are buried, right? From an accounting risk standpoint, they're doing too much, and so we want to see a layer of management in the business that is going to continue with us because there's just too much ground for us to make up, for both from the standpoint of acquiring that asset and then growing it. As well as if we have to make a management transition where we have a seller that really does need to retire over a 2-year period, they have a level of expertise you're just not going to be able to replace in a short period of time. And we view that as extremely difficult to do, actually. So I think the default, let's call it traditional searcher path is that, oh yeah, I'm just going to take this thing over and it'll be fine. But the reality is the management transitions, even for experienced players, are very complex. So that's a really big one. We want something that is affordable, that has the opportunity to generate returns for investors. One of the issues that I've seen in this space has been that the purchase prices that people have been willing to pay for assets has been, in some cases, creeping up, and in other cases, just way too high. I mean, if you think about what a multiple of earnings is, it's how many years till you're paid back, right, on your investment, right? So you really need a layer of protection, a margin of safety in the transaction purchase price, especially for these small businesses. We want EBITDA, for example, to be a really good proxy for free cash flow because depreciation is a real expense, taxes are a real expense. Like that's cash you don't get back in that year. I mean, EBITDA is a good proxy for lenders to say, hey, what is my leverage covenant ratio? But really, what you care about is free cash flow for these smaller businesses. It's very rare that you can look at something that's going to trade on a high multiple based on EBITDA, right? So those are
Yeah,
those are the primary criteria. We have a ton of secondary criteria, but those are primary criteria.
and I think this is why a lot of what you and I spoke about to date has resonated with me a lot because we had a conversation not too long ago, and I think 2 out of the 3 items you just listed, really all three, and rolling them up into that margin of safety concept is the fundamental approach that we take as well. We both adhere to those kind of core value investing tenets, and ultimately the key person in management transition is something that we scrutinize really closely. And I think I shared this with you, but what we've noticed so far is there's benefits and drawbacks to having a self-funded search model versus the independent sponsor model. And the self-funded search model, of course, you got someone who's personally guaranteeing a loan, who's got really strong downside alignment to make sure things don't just absolutely hit the fan. But at the same time, there's generally a lighter team, someone probably who's in most cases a first time buyer. And that means the transition is really the big make or break for a lot of
Yeah.
folks. Versus in your world, in the sponsor world, the business you've built, you've got experience and a real kind of bench to guide folks through that transition. And we have seen that sponsors who are on deal number 3, 4, 5, whatever, have been able to navigate that transition more effectively. So it's a real value proposition that you bring to the table there.
There's a lot of planning that goes into when we're looking at a transaction. We're thinking about it from the onset, right? We're planning for it all the way through, and so we're planning for that all the way through. And we have scenarios too where it's like, what happens if somebody gets hit by the bus, right? We have to answer those questions because unfortunately those things happen, right? It's we've already been in assets where we've had management team members have health issues that have taken them out of operations unexpectedly. So you have to plan for these things.
Yeah, the contingencies and building the org chart depth, but also building those, whether it's recruiting relationships or just keeping a constant pipeline of talent in the mix, is it's hard to do that when you're truly a self-funded searcher and you're kind of a lone wolf. And what we coach a lot of folks into is in the first 12, I mean, you've got your first 100 days. That's a classic cliche where you want to get some wins in, you want to set up the foundation, but at the very least in the first 12 months, set your foundation so that from there you can really fortify the base and then you can grow into things. And hopefully you're paying down debt that whole time as well, which obviously fortifies your capital structure.
Right. And I compare and contrast SBA versus independent sponsor world. I mean, SBA is, as you know, just a fantastic mechanism for wealth creation. If you buy an SBA business and you use the conventional structure for acquisition finance, be it raising equity for your SBA deal, there's almost nothing comparable to it, right? If you knock that thing out of the park, the downside is that you may buy something and may be highly levered, and you may be prevented from pulling certain levers in that transaction. The another sort of challenge I see is that the folks who buy these deals and they really kind of LBO the SBA transactions, you really need the thing to cash flow. Like it's one thing to get the deal done, etc. But you need to have that excess cash available to you. And I think a lot of folks who go into that SBA route are not necessarily thinking about that. It happens on our side too, not from anything that we have done, but we see it all the time. A very high personal leverage is a bit out of whack, and if you get into a bad quarter, bad month, that can be enough to get you in trouble.
Yeah. And that's underpins, for the passive investor folks, that underpins the fact that if, especially in some of the SBA deals that are more highly levered, which don't get me wrong, we'll do SBA deals, but what we're very focused on there is getting the capital structure right and making sure that we're not getting in at a point where we've seen deals where the business has to grow 10 to 15% off rip for it
Yeah,
to pay down the debt. And that's your point. You
that's
have one
that's
bad
tough.
month and there's a capital call coming in. So for the
Right.
passive folks, either be ready for you got to be prepared and have some cushion that there may be a capital call coming down the line, especially if that capital structure is really restrictive.
Very, very much the case. One of the underwriting criteria is, well, you of course want something growing faster than the GDP, right? That would be ideal, but you're not going to go faster than rate of GDP in perpetuity. It's just not going to happen. And statistically, you're just going to revert to the mean in terms of what your growth rate was on average. There are obviously inorganic things you can do to grow that. There's financial engineering, et cetera. But most businesses are going to grow at the economy, and there's nothing wrong with that, right? They're going to grow at the rate of their industry. There's nothing wrong with that. And so I think buyers need to be really mindful of that, and of course sellers need to also have that proxy for that relative value for a buyer.
That's spot on. But to shift a little bit and kind of dovetail off some of the team related items you mentioned, what attributes do you look for in leaders that you partner with? So the kind of searchers or the operators that you're backing. What do you look for?
Yeah, it's a bit strange, right? Because of course, when I did this, I had no real operating experience. I was sort of doing deals and had consulting experience and had been in a number of complex situations to solve these problems. What what we've shifted from is, hey, we want passion, to actually we we need a couple of tactical skills. right? They need to be able to read financial statements. I guess that's really important. They need to have deep industry experience. One of the core ideas behind Thesis is that we're working with folks who have a specific industry thesis, and then we're building a structure around them to go find an asset that matches that specific expertise. And so, if you don't have, you also have to have a passion for that component, right? So that's a first original filter. We still keep that in a way, but we've modified it. You need to have led other people, right? And you need to be set up in a way that you're at a point in your career where that's where you will do best. And so we look at a number of characteristics, a number of bullet points to say, this is the type of asset you would do really well with, right? So I've had folks say, hey, here's what I'm looking for. Here's my thesis. Here's my approach to the world. We've gone down to the base layer of who that person is, and they're dead set on a blue collar type business, which is fine. There's nothing wrong with blue collar. But for this person, they didn't meet any of the markers of somebody who would do well in that environment, right? And so we look at a number of behavioral characteristics that match those other criteria that I outlined. And then, of course, we're doing the natural, hey, let's do a background check. Let's talk to references. And when we talk to references, we don't ask for, we say, look, all the good things about this person are going to come out. Like we're going to see the good things, right? That's just going to naturally emerge. We don't care about that. Tell me about the specific weaknesses of this person. And sometimes you get very funny responses like, oh, I'm not going to do that, right? Because it's a very uncharacteristic way to do a reference check on someone. But the data we get from that and going very deep is extremely helpful because it's insight into the person's character, into how they've solved complex problems that we wouldn't otherwise get, and is a litmus test against some of these other tools that we use to make a determination if we should partner with somebody. And then unique to our partnership, we're working with someone for maybe as much as 2 years before we even get to a transaction, right? These things, they take time, especially the really quality opportunities that you go very deep into. So that's a little bit of the flavor of kind of how we do things.
Yeah, that's great. I think asking the tougher questions both to references and to candidates is key. I spoke with a gentleman named Christian Ruff a few weeks ago who recruits special operations folks as independent sponsor operators and in other lower middle market roles. And one of his questions is, what do you do if you're standing in line at Starbucks and you see somebody steal a candy bar? And then he just lets them speak. And I thought that's a good one.
Yeah, that's pretty clever. Yeah.
There's no right answer to it, but it gets you talking and it gives you some insight into things like integrity or things like how vocal are you about these situations. And again, it's to your point on, is somebody behaviorally and emotionally ready to be a leader of people? Best indicators that they've done it before, and especially in that industry, the right type of groups that they've led, and a track record of doing that. But you can also learn more by asking references and by asking the right questions.
That's right. And there's lots of talks also about the data that let's call it traditional search fund investors use. And we use all those data points, right? And also encourage investors to, specifically passive investors, to also look at those criteria. It's all publicly available. And we use that too, right? We've enhanced on top of that. But I would say those characteristics, one of them is a very crisp communication, right? Your ability to articulate the problem you're trying to solve for the person you're trying to solve it is also an important criteria. And that was something that kind of came to mind with your stolen candy bar story.
Yeah, no, that's great. The frameworks that I think come from a lot of the traditional data are great. We use a couple. We use ones around, there's a report called, I think, Death in the Afterlife or something like that. That's all about failed
I haven't heard
search
that one.
funds. That's a great one. Yeah, it's all about failed search funds and what were kind of the commonalities there. So we have what we call the failure indicators test. And can we identify any of those and potentially mitigate them during the deal process? That's one we look at. And a lot of those, to your point, are around more soft attributes of the searcher, right? Communication, less soft, like industry experience, leadership experience. But there's also, really interestingly, the dynamic between the board and the searcher was really big, right? And that's always been big in the traditional world, this mentorship, this governance. A lot of that, I would say, is more frequently lost in the self-funded search world, potentially. I think the independent sponsor world, part of what's really neat about it is, you guys, Thesis, bring that governance, you bring that experience, much like the traditional investors in the search world bring. So obviously we aim to bring some of that to the self-funded search world, and when we build a syndicate that's more experienced, we look to bring that. But it's great that you've got already got it at the table.
Yeah, I would say that there is this. I keep running into this kind of classical problem of folks. It's, I want to own the whole thing. I want to do this myself, etc. It's like, well, great, go fund an SBA deal yourself. But if you look sort of categorically at the larger businesses that just exist, search fund or whatever, but larger businesses, they are they're collections of exceptional people, and no large thing has been done by a single person. And so if you're trying to accomplish very big things, you just can't do it alone. And boards play an important role in that. So does the team you're with, and people need to shift from this self-made mentality to like, how do I get the best team to help me accomplish my goals? Right? It's a sports game. I mean, that's really.
Yeah, that's spot on. Great. Well, we've talked a lot about team and people. Maybe just to shift kind of to the horse side of things. How do you pick a really good horse to back? A great acquisition target. How do you look at the company? How do you look at the historical financials and all that stuff? What do your criteria look like when you're evaluating an actual target with an operator?
Yeah, you bet. I've written about this quite a lot, so it's all on my our website. But um, we want to look at 5 years of financial performance for a business, because the world is different every 5 years. But it's how did management make decisions over that period of time? How did the company perform relative to its peers over a period of time? And I think 5 years more than 3 years gives a better picture of that. So almost always when we're talking to, if something is on market or off market, hey, we need 5 years of financials, and like there's a little bit of a harumph for more than 2 or 3, but we want to look at 5. I spent a lot of time on the balance sheet, actually more than the income statement. The balance sheet really tells you the history of the company, like what they've actually done with the cash, and what they have done if they have assets or machinery or equipment or one of these things, like what they have done with those things. And I think tells a better story. So we pay a lot of attention to that. And then on the cash flow statement, we're really looking, as like I told you previously, it's like, well, what is the proxy of free cash flow to EBITDA? For a lot of companies, the United show really positive net income, you generate no cash, right? There's no cash that comes out of the business. And so you want cash that can come out of the business, or opportunistically have the opportunity to reinvest in the business, and then have that sort of tie back into revenue if they are reinvesting into the business. That's sort of how we look at the financial statements. And that's usually first filter, and vast majority of companies fail that. And so we just say, no, doesn't quite work. Or generally speaking, if you have a company that has a lot of depreciable assets, like you buy equipment or some other component, you want that capital cycle for that set of assets to be something that is, you're not buying it cyclically, let's call it. You're not buying a bunch of heavy machinery that's already depreciated that you need to put back into the business. So you want that depreciation to be something that is actually like almost like a turned inventory, and that's a really clear return on incremental capital for the business. So free cash flow, ROIC, right? Two very big components, and ROIC, so return on incremental invested capital. So I think we start there. Then it comes down to the business economics themselves. So I think it's better to look at a business from the standpoint of biology, right? It's, you have an animal, the animal lives in an environment, and it has developed a set of both behavioral and physical characteristics that have allowed it to thrive, right? What are the animals that are going to come and take its territory, take its food, harm it, right? And build a bit of a model around that business. We spend a lot of time on microeconomics more than macro. Like, I don't care what's happening with tariffs too much, right? I don't really care about what the Fed is going to do. I really care about what are the particular microeconomics of the business. Like, can it increase prices if prices change? Like, do they have that pricing power with customers? Or is it a Q versus a P, right? Like quantity versus price, a dynamic, or is there something more complex that I need to understand? I wish more businesses were Q versus P. It's never that simple, but whatever. And then relative to peers, what are the economic durable competitive advantages that the business has, or what are the specific weaknesses the business has relative to its competition. So I can talk about that in a simple form. We say, and it's true, if we're investing in a business, we want to be able to hold that business forever. And forever is commonly panned by Warren Buffett and folks, but it's actually a very good underwriting criteria, because if you're in an asset and you can be in it forever, you're generating a rate of return that's hopefully north of what the S&P 500 or a comparable could do. You've underwritten the asset correctly, and it is a good long-term compounder, right? So why would you sell it? And it helps you think about, well, what's going to happen in 10 years, right, for this asset, because actually, hey, certain businesses are not going to be around in the same form in 10 years. I don't want a business that is going to have fundamental change that I have to facilitate inside the business, because the probability that I will get that wrong is actually very high. Like I haven't operated the business for 14 years or whatever, like the seller, like it's so we really want the situations that the catalysts for change are very understandable, and the microeconomics of the business are very durable. So those are some key criteria that we look for.
Yeah, I think those are excellent pillars. And a lot of folks overlook, just to start with the first comment you made, a lot of folks overlook the value of studying historical balance sheets and really looking at the trend of return on invested capital, right? Because you can learn a lot about a business by digging into where they're redeploying capital, and how they funded growth, or how they funded the business to where it is today. Have they needed to rely on a lot of debt to kind of float things along, and all of a sudden that ROIC is declining? Versus if you look only at a metric like return on equity, you totally ignore a big chunk of the capital stack as well. So it's great.
Exactly.
Great commentary.
And I think so. This is another just fun tidbit. So most of the economy is a service economy, right? We're 60% service. It's disguised in a lot of these companies, but actually that capital spend is personnel, right? It's people, right? It's a human capital problem, and that doesn't necessarily show up on the balance sheet. And I think investors, entrepreneurs need to be really cognizant of, yeah, but is this a labor problem that I can scale away from? In most cases, I think the answer is no.
Mm-hmm.
But that's a lurking variable that exists in all these businesses, is the people.
Sure. Great. Well, maybe, since you've had a handful of deals under your belt, and you've also seen lots of other folks that have done similar deals in the space, what are some common mistakes you see? You talked about one in terms of purchase multiple, right? If you buy above a company's intrinsic value, you inherently have the market working against you. So what else do you see that?
Yeah. Well, I think that's a big one. I mean, I think you have a lot of these people who overpay. We get tons of stuff that comes in our inbox all the time. It's like, hey, we're raising for this, and I can't make the numbers work. I had a deal we really liked that I just politely passed on, or somebody that we knew, and we put in an offer, and we thought it was like a little higher than what we were kind of comfortable doing. So somebody offered like 2x what we offered, and it's like, yeah, good luck. Purchase price is really important, because it is the fundamental downside protection, right, for any of these transactions. It really is. It's the primary downside protection you have. The other component that I see where there are sort of major and serial errors from investors, operators, is, you'd mentioned this, they get the cap stack wrong, right? Either your leverage profile or the maturity of your debt relative to the asset, the structure that they're going into with the seller, and in some cases even their preferred structure, right, relative to their equity. So let me talk about seller financing, right, as a good example. In independent sponsor world, most seller notes are fully subordinate. They are on full standby, equivalent of what you'd have in the SBA. You're not typically paying any principal. It's maybe there's some interest payments paid, and it sort of comes due at the maturity period for your primary note, what have you. I've seen a lot of deals where inappropriately people are paying principal and interest on the seller note, and the lender, senior lenders, whatever, I'm just getting a deal done, and it'll be their problem to figure out. And in some cases, you need that seller around for a year or two as you're transitioning the business, and it is not inconceivable that you could get into issue with the business. There's some problem Q1 as soon as you take the thing over, that you need that seller on your side. And so I think setting the right expectations out of the gate is really, really important. I've seen a lot of issues where people don't have those structures, and then they said, well, I'm just going to go back and renegotiate during LOI phase, both on the seller note, but on other elements. It's better to just win the LOI out of the gate and just be honest with people and say, hey, here's what I think. Here's market data, right? Support what you're saying with market data, as opposed to I'm just gonna get this thing under and then change my mind and convince the seller that I'm right. I think you're setting yourself up for challenges both in the transaction and then after the transaction, because you've got somebody you've already sort of destroyed trust with. Now sometimes things do need to change, but that needs to happen. The other mistake that I see just time and time again is you don't have a clear path for building redundancy inside of the business. If you're buying something without that kind of extra management layer, almost always all of the what's called SIMs, offering memorandums I see from other folks, they're not accounting for the cost of the additional personnel or the cost of growth, like often in marketing or sales. And when they are, almost always underrepresenting what that cost is going to be. That's a real dollar cost that's going to come out of the business. And for most of these businesses that are where you're transitioning, especially if you're reporting out to a board or reporting to investors, et cetera, you're going to need an extra layer, right? You're going to need some additional accounting and support help. So your costs will almost always rise a little bit after the transaction because of those reporting costs. In our case, almost all of our stuff is audited, right? We have to present those audits to investors. And that is a cost to the cash flows after we acquire the business. So those are a couple common examples of what I see. And personnel, I think, is a big one because it's like, well, who do you have on your team that is going to jump in there and solve that problem? And we've had people that we've had to like, hey, we got to make a swap here, right? Because it wasn't the right person for the right asset, not from a executive management layer, but from the standpoint of maybe we needed some additional accounting help, right, to get the reports out on time.
Yeah, that's a great point. It's relevant, again, going back to the comparison between true self-funded search, SBA models, and more independent sponsor style structures. It's very relevant on both sides. You probably have more, I mean, naturally, if you have a bigger business in the independent sponsor world and you have the bench support from a deal team standpoint of the sponsor and whoever's supporting from the sponsor's firm, plus, the operator, you've got a little more bandwidth to kind of set up some of those just kind of foundational infrastructure elements from a people standpoint. But It's something we not only aim to support with, but also encourage any self-funded searcher that we're backing, that they need to get on top of that pretty early on. How do you build contingencies around and redundancies so that you have depth in the org chart and that you're not relying on one person too heavily? Because, as we've talked about, one of the key criteria that we look for is, or one of the key risks we look for is key person risk every time, right? And it's virtually always going to be there. So how do you accept it and then build a team around the need for redundancy and a team around sourcing people that can replace or step in for whoever may need to step out?
Yeah. I think for the smaller deals, like the much smaller deals, it's you have a let's say that's a self-funded searcher deal, let's self-funded SBA deal. You have, of course, that executive. They need to have some board representation where they have somebody who could parachute in, or at least the board has a very clear path of, hey, we could go get a recruiter and parachute somebody in if the worst happens. You've got to have that continuity plan. That's like a bare minimum, table stakes. I think too, for management team that's coming in on these acquired assets, having that clear line of sight to who in the organization could I promote to take on more responsibility. Not necessarily all the responsibility of running the show, right? Because you can interim somebody with like a board member or something like that. But who are the people I can say, look, this is a short-term thing. I need to put more weight on your shoulders. Can you bear this weight? I think you've got to have an acquisition target that facilitates that, but then be very clear line of sight to being able to have discussions with those people should those events occur. On the larger scale, if you think about the larger transactions, especially the ones that we do, we have several layers of that. So it doesn't make a perfect solution, but it certainly makes things a little bit less risky.
Certainly. And then the step after that, right, is if someone steps up to the plate and does really well, how do you kind of adjust incentives to make sure that person keeps doing what they did really well, right?
Yeah. Oh, 100%. So in the what's called larger transactions where you have a board, et cetera, of course, people have their participatory economics from the transaction, but it's really the board's goal to make sure that they have the right CEO in place, the CEO is not overstepping their bounds, and that they're appropriately compensated for the value that they're delivering for the market. And so, in the context of a very healthy transaction, it's the responsibility of the board to ensure that. And in some cases, of course, the entrepreneur is on the board, right? As in a number of cases, it's appropriate. In certain cases, it's not. In other cases, it's happenstance that they are or they aren't. Uh, I'd say having a good board helps solve that problem.
Any kind of stories you want to close out with, or any final
Yeah,
remarks you want to hit?
plenty of stories. I think one in particular that is a pretty fun story. We invested in one of our companies, and we took team members from a previous company that had done specific activities inside of. I said, "Hey guys, like we have a new opportunity that very very similar to a previous opportunity that we invested in. We're going to do the same thing, but with a slight tweak." And so that was a fun and unique challenge because people were, "Hey, we had just got to the end of the pot of gold, so to speak, and they were not expecting to kind of like go to the next rodeo pretty much immediately." But we went back specifically to a number of our marketing folks. And we said, "Look, we have this opportunity. We didn't get it. Are you ready? Are you ready to jump in?" So the answer was yes. And we started this new acquisition. We had basically the whole team that we had built over a prior number of years that started with this opportunity. Literally day one, day two, sometimes a little bit longer. People were on vacation, etc. And we did exactly everything that we did before with the first business, and it worked. And now what has happened is inside of that business, a bunch of those people have started new businesses. And so the story I would say that's the important takeaway is that you really need to look at the people that you're building these businesses with as people who can continue to go on that journey with you, and then give them the opportunity to go be entrepreneurial and start their own businesses. Empower them with the tools that enable them to be successful, do what they do best, etc. The reason why that's important is because um, after that, it's called second rodeo. Now we're talking to one of the guys who was with us, and still a good friend, and we're going to look at buying a business that he started as a function of going on that second rodeo with us. So you're building a team, and you never know that that team may ultimately result in a transaction opportunity for you. So get exceptional talent, get the best people you can, bring in entrepreneurs, and go on the journey with them. That's part of the fun, and you never know where that road's going to take you. It could be very circuitous, as it is potentially for us here. So I thought that was the fun story that's kind of unexpectedly occurred.
Yeah, yeah. What a great cycle, right? You go through two deals together, and now coming back to do a third, except you're buying his business. So that's very neat.
Yeah, exactly right.
Cool. Well, Ian, thanks so much for joining us. This was great. Appreciate it.
Yeah, well, thank you very much, Sean. Appreciate the opportunity. This was fun, and thanks very much.